Just how big an impact are higher oil prices and higher crack spreads going to have on the global economy and on some of our critical businesses? We're going to talk about that today with our good friend and colleague, Professor Mark Guthner of Rutgers. Hello, everybody, and welcome. I'm Mike Coe. Welcome to Office Hours with Professor Mark Guthner. Mark, how are you, my friend?
I'm doing very well, although I'm getting a little annoyed these days because I keep getting too much spam on my phone. So it's
Do you have a? I'm sure you have an Apple iPhone.
yeah,
Is that correct?
yeah.
Is it political in nature? What kind of spam is
It's
it?
investment stuff, and there's like buy this stock, and if you want to buy the next Nvidia for 47 cents a share,
Oh,
it's that kind of
that's.
stuff. And I keep blocking them, and they keep coming back.
I keep getting. Your Coinbase authorization code is going to expire in
Yeah,
so many minutes. They basically try to
yeah,
make it look like somebody's withdrawing from your
yeah.
Coinbase account, and then you presumably in a panic reach out to them, and then confess the world, and they
So what you
steal your
got? Yeah.
crypto.
It-
So yesterday, when we did the open mic, one of the things we talked about was the really unusual futures trading activity that took place before the open. Around 6:50, there was a huge buy of the S&P E-mini futures contracts, and there was a huge sale of the WTI, formerly NYMEX,
Mhm.
now CME, front month crude contract. And both of those trades, I think, were up over 50 million bucks within just a handful of minutes after after the post went out from the president's Truth Social account, which I think I had mentioned that I actually got a Truth Social account specifically because it seems like his posts move markets, but I just don't make it a habit to log on to Truth Social. I don't
Yeah.
look at Truth Social. I'm and even if I did, I probably wouldn't be staring at it all the time. So didn't do me much good. But not sure that it would have, given the amount of time that was involved. And it looks like this person had some insights even before those posts went out, and that's obviously where the real money was made. But you've been taking a look at a couple of things. We were talking about it just before we went on, in terms of the impact of crude prices, the crack spreads, and things like that. What's on your mind?
Well, I have seen several articles suggesting that there are diesel shortages throughout Asia, and it's getting quite serious in Australia, where there's some panic buying of diesel, and so diesel is so important for moving product around. Um, and then I was kind of wondering why, but they've got a shortage of product to refine over there. And then that just got me thinking about that sort of a derivative trade that maybe is not quite as risky. Maybe I don't know, but that's something to talk through than buying crude outright, because um, what's happening in the U.S. is people don't think that there's a shortage here, and we don't really have shortages, particularly because we more or less produce all the oil that we need to consume in terms of jet fuel, gasoline, kerosene, um, diesel, all these kind of distilled products, and so we don't necessarily have the problem. So I was a little surprised to see crack spreads up, but one thing people forget is it's just not oil that gets moved around the planet by tanker. That refined products get moved around by tanker too. And I'm sure there's we've got diesel going from here in the States to Asia, and that's driving up our crack spreads. And the comment you had before we jumped on the show about something equivalent happening in the jet fuel space, which I hadn't heard, is
Yeah,
compounding.
so I have some stuff up here on my screen. So when we take a look at this, first of all, this first chart here, which is a 1 year chart, this is of Brent. So Brent's sort of the global benchmark for crude. We could look at WTI if we wanted to. Oops, not
Yeah,
that.
the Europeans focus on Brent, and we in
Yeah,
the U.S. focused
we
on WTI.
yeah. So WTI used to be the benchmark for the world, but now it is
Yeah.
Brent. But I mean, as you can see, it doesn't really matter that much. WTI is up 66% off the lows, and if we look at Brent is up a like amount. I'm pretty sure. We'll see. I'm just going to go from the January lows, 75%
Yeah.
for Brent. But what I was noticing was that what really got me looking at this was I was observing the performance of Delta Airlines compared to a lot of other airlines around the world. And what I noticed was that Delta held up a whole lot better than almost everybody else. So we can actually take a look at that here. So if we take a look at JETS, which is just an ETF, which appropriately named tracks the airlines. And I'm actually going to not look at the January highs or the February highs. Instead, I'm going to look back in this region here in sort of mid-early December. And the reason I'm looking at this is because this was the region right in here when crude was trading at its lows. Crude got down, West Texas got down to about $55 a barrel at that time. So that obviously was kind of interesting. And then I looked at Delta and I noticed, well, wait a minute, it appears that Delta hadn't dropped as much, so I was kind of just trying to work through that problem a little bit. And you can see that you may or may not be able to make this out, but one of the things you're going to notice is that Delta, so this is the beginning of December, Delta is actually marginally higher than it was in early December. Most of the airlines are of course lower. Now, a lot of folks may not realize that one potential reason for this, well, Delta has a stronger balance sheet than a lot of other U.S. carriers do. It has a better and more robust business because they rely more on upper end and business travel than, say, JetBlue, Southwest, places, airlines like that. So the stronger balance sheet than America and United, the focus on the business traveler, and the rather unusual characteristic, which is that Delta Airlines owns its own refinery. They bought a refinery outside of Philadelphia in 2012. They purchased it from Phillips 66. Now, owning a refinery does not insulate you from oil prices, but one of the things it can do is it can mitigate the risk of the crack spread blowing out. And the crack spread is the difference between the price of crude and the price of refined products. So it's called the crack spread because the process of refining crude into the products is cracking the hydrocarbons, right? So that's why they refer to it that way. And as evidence of this, and also just the fact that you can have short-term supply and demand disruptions that are in the products, because even if you have a certain amount of crude, different areas consume different amounts of certain refined products. Now, if you take a barrel of crude oil, 42 U.S. gallons of crude oil, and you refine it, you will typically end up with crudely, pardon the pun, about 50% gasoline, about 25% diesel, jet, kerosene, that kind of stuff, and then 25% other products, naphtha, and so on. And in the United States, as it happens, we consume, if you added up our sort of distillates, that's, the diesel, fuel, and heating oil, which are the same stuff, by the way. Basically, the only distinction between those two things is that one's got a dye in it, so that you have to pay a road tax on one and not the other. And so we use about twice as much gasoline. So if you think about what I just described, which is that a barrel of crude is about 50% gasoline once refined, and about a quarter distillates and jet and kerosene. Kerosene and jet fuel are about the same stuff, right? So that means that if we produced approximately as much crude oil as we consume, which is about 20 million barrels a day, and that is in fact about what we do produce in North America, which is what you were alluding to, we should be in pretty good shape. Now, of course, a lot of what we are producing is also coming in the form of natural gas from fracking and so on. So it's not that we perfectly produce everything we need, but we're in a better spot than many other places. But here's what I wanted to show everybody, and that is this. So this is the price of jet fuel in Singapore since the January lows, up 124%, give or take. So we've got Brent up 75%, but jet in Singapore. So you have a cargo plane or an airliner that you need to fill up. That's a problem.
Yeah, it's huge.
That is significantly a problem.
Is that in dollars per barrel, by the way?
This is actually not in dollars per barrel.
Index.
No, yeah. This is, so I can switch it to U.S. dollars if you like, but the percentage will be the same, right?
Yeah.
So,
Well, it says 175, so I just.
Yeah, that's not going to be So that, just so we're clear, that's not going to be. We think about things on a price per gallon, and that's 175. So this is the U.S. dollars per barrel.
Now. Yeah. Okay. Got it.
So you divide that by 42, and that gets you to your per gallon price.
$60 premium, $65 premium over.
That's the real thing that matters here. And actually, I also have this is the crack spread.
Yeah.
We can see that this has been quite volatile as well. So if you think about it, the increase in the products, if there was no increase in the crack, would be dollar for dollar.
Mm-hmm.
But if both are blowing out, then you're going to have a more significant increase on the product side. And that indeed is what we're getting. So the crack blew out
200%.
How about that? 200%. From early January to the high.
Mm-hmm.
It's obviously not as bad now, but it's clearly not very good. Still up 136.26%. So that's definitely an issue. So what do you think? I mean, how long do you think we can stomach, the global economy can stomach what's going on before we sort of could deal with a formal recession for the year 2026?
Well, that's a good question. I don't know. I think the U.S. is in better shape than the rest of the world because, as I mentioned, we more or less produce what we consume here, so we don't have to import like they do in Europe and like they do in Asia, particularly from the Middle East and off of Africa. Well, the stuff off of Africa, I guess the state-owned oil companies are probably doing quite well there because they can get their oil out unmolested. I don't know.
The thing is, though,
I don't know.
I mean, if the prices are higher, that's going to sort of clip consumers, though, isn't it? Even if we have enough.
Yeah. So I don't, I just don't really know what to make of it because if you think about GDP, well, people will be spending more money on gasoline, but spending less money on other stuff. Does that net hammer GDP in the U.S.? I don't know. I don't think so. But I can see if you're in a place where you're importing your oil, then whatever you're spending more on there, that means you're going to spend less on everything else, but you're not getting credit in your GDP numbers for what you're spending, right? Because that money is going someplace else. That's becoming an import. So they'll have a harder time. I think it's very possible that we have a zero GDP print in the next quarter or two. At this stage of the game, I just don't know how bad it's going to be. I don't have a feel for that.
What is? I guess my question would be also: you're on a university campus. What is the sentiment on campus right now, by your estimation, for what's going on?
Here at the business school, nobody seems to care. Students don't seem to care and stuff like that. But That said, the folks that tend to want to demonstrate and things like that tend to be on the main campus, and so we're kind of off, a 10-minute drive from those folks. So um, I'm not seeing anything, and even when I drive through the main part of campus, I don't see anybody demonstrating. So I don't know if people are really worked up about this or not. I'm a little surprised that people are not a little bit more worried about this war, and especially throughout the U.S. in general. Um, I'm surprised that people are kind of accepting what's going on without too much um, pushback.
Angst, pushback.
Yeah.
I one of the things is that I feel that Americans, maybe people globally, have been anesthetized against a couple things that would normally have alarmed them. For example, big numbers, big deficits,
Hmm.
big debts. People are so used to hearing numbers in the billions and the trillions. It just doesn't mean anything to people anymore. They kind of ignore it. And one of the things that is also the case, and I happened to look at this recently. My father was born in late 1937, and his father died 3 months later in a training exercise in a Glenn Martin bomber preparing for the Japanese to invade. They were in the Dutch East Indies at the time. And I started to look at the calendar and I realized that effectively since the United States joined World War II, the country has effectively been involved in a military engagement, whether major or minor, almost continuously ever since. That
Yeah.
means that for virtually all of my father's life, for all of my life, and for his grandchildren's lives, one of whom's about to go to college, the United States has been at war. And what I think that means also is that folks are anesthetized to big numbers, they're anesthetized to debts and deficits, they're anesthetized to war.
Yeah.
Because war is actually that's the baseline. The baseline is that we are involved militarily somewhere on the planet.
Yeah.
That is kind of we talk about the horrors of war. One of the horrors is that we have become inured to it. And I think that might be part of the reason why the response to this seems to be a bit quieter than one might have expected. Now, I happen to live in Northern California. I live in a very liberal enclave outside of San Francisco. It's probably unsurprising to a lot of people that around here they are not so inured to
Hmm.
it. But you know what they are inured to are protests, because we have a protest going on here pretty much all the
Yeah.
time. There's always if I go on the 101, the overpasses, there's always somebody waving flags and asking for you to honk about something or other. So it's like it's pretty much constant. And so that also is sort of the constant state of affairs. It feels like the people who are in Washington change, but things don't change. Right? It's this, no matter what happens, we sort of seem to get the same sort of set of circumstances.
Yeah, that's why the critics call it a uniparty. That the parties are really kind of do the same
One
thing. It's
bleeds
just
into the other.
it's just a matter of how you adjust you throttle the dial a little bit. A little less taxes, a little more taxes. Nobody says get rid of taxes. A little war, a little less war. Nobody says get rid of the war. And stuff
There
like
are
that.
some. I think people like Rand Paul,
Yeah.
right? He's the senator from Kentucky.
And Massey.
Yeah.
The other thing
so
that
this is
that before you get away, because I want to make sure you hit it, is this idea that the deficits are bad. Because remember, we've grown up with deficits are bad. Government's going to go bankrupt. deficits hit $2 trillion and nothing happens. We keep having these fantastic numbers, and I think now it's like if anybody says there's a problem with a deficit, it's like crying wolf.
So, yeah, I mean, I guess I was saying this before we went on, and I figured I would share it now because I think it helps illustrate that the problem is there, the problem is real, and we are feeling it, but because of the pace of change, we might not necessarily realize it. So, first of all, we had Pangea at one time, and the continents drifted apart, and they drifted far apart on a relative basis, which means that given enough time, a lot can change, and a lot has changed. Here's the example that I provided. And what got me thinking about this was, before we went on, I had to pay my car registration renewal. And that renewal for a couple-year-old car, this is California, I realize everything's expensive here, but $937 which is about half the price of my first car. My first car was, I think, about $1,800, if I remember correctly. The first car that we bought that was not a hand-me-down from my parents, that is. And that got me thinking, and I thought, well, actually, about my parents, they bought, if memory serves, they bought the house that they currently live in for $24,000. And I figured out that over the course of the last 8 to 10 years, if you add the sales taxes I've paid on cars that we've purchased and the registration for all of these cars over time, now we have 3 going on 4 drivers in this household. We have 3 cars, so I guess I don't know what the average household has. Maybe it's 2, maybe 3 is a little bit above average, but I figured out that we have spent in sales taxes and registrations on all of these cars approximately what my parents paid for their house, which is a reflection of 2 things. It's a reflection of just how, and they always talk about, increasing these fees, increasing these taxes, whatever. But it was just an online thing. All I had to do was confirm that, yes, I'm going to continue to use this car. I went online and gave them my credit card number, and that was it. Right? So it's not like there was a whole lot of hard work that the state had to perform for this to take place. That's going to now print out an updated thing and send me a sticker, which I'll put on the license plate, and that will be that. But it shows the impact of inflation, and it shows the impact of this drift in fees and taxes on things that takes place over the course of time, and how remarkable that is. The house that's next door, I think I've shared this before. Right behind me, about 300 feet behind my back through that wall, is a house. We knew the prior owners. They bought that house in 1977. They sold it. Well, the gentleman who lived there, he died of cancer, unfortunately. He was a very nice guy and played golf with him once or twice. But his wife ended up selling the house. They bought it in 1977 for $33,000, and they sold it. I think it's 3 years ago, for $3 million. So again, these impacts that people, they say, oh, we keep saying these things will be disastrous, and people say, but the world hasn't blown up. Well, but it has blown up. Nobody can afford to buy a house out here. The median house in California is, in the country, I think it's more than 10 times the median personal income. But in the state of California, I think it's probably closer to something like 20 times the median income. Oh. And so I think people should just be aware that, indeed, these things have blown up. But they happened so slowly, like the continents drifting apart, but it happened within the span of life, that that people do need to pay attention to it. And the signs are there. Yeah. And now I'm concerned about how this is good. If we're always at war, one of them's bound to turn out a lot worse than some of the earlier ones did. I don't know that this one will, but it definitely feels like we are in a precarious position if this doesn't get de-escalated sometime soon.
Yeah, I don't know that the world can take oil prices at above $100 for, you know, 3, 4 months times. Time will tell if that's right or not. But if the war continues on, we're going to see higher oil prices because the compounding effect of restricted supply day after day after day makes shortages that much more difficult to live with.
To make and to make
Yeah,
up also. It's not as if you just turn the spigot on and everything goes back hunky dory to the way it was before.
yeah, that's one of
Um,
the other professors here. Her father made his living trading commodities, so I was asking her if she was trading this, and she was looking for a quick resolution. She was trading the commodity for a quick resolution, and I said, it's not the one. It's not my base case. And even if they stopped this war 2 weeks from now, the the emptying of the supply chain is going to mean we're not going to be back to normal for another six months to a year. So we'll have elevated prices for a long, long time.
I was looking at this yesterday, and I'm just going to pull this up right again. So this is just going to be the tankers, and what I was looking
Mm.
for was traffic going through the strait. And yesterday, there was some traffic. There was some tanker
Yeah,
traffic. There was a tug that was going through here. There was a Thai cargo ship that was going through here. This is tankers only.
yeah,
Um, the traffic that was going through. So let's take a look and see who owns this. This is a products tanker. It's underway, and it doesn't say who the owner is. This is going to Bandar Abbas. And also, I saw a ship that over here, also going to Bandar Abbas. There was one right over here that was going, I think, to Karg Island. Here we are, yeah. But you will notice, and this is the important thing, right down here, beneficial owner, NITC. So when I was looking at the traffic that was going through, because mostly the ships aren't moving, it was Chinese ships. It was one or two.
hmm
A Thai cargo ship, and then mostly ships associated with Iran,
yeah.
which is certainly an issue. Actually, we have some questions here. Let's see what we've got going on here. So Monday Morning Quarterback, I was thinking about oil supply chain issues more along the shortages in Asia, Korea, and Japan. Seem to have big reserves, but others like Indonesia seem to have a problem. Doing more research. Yeah, so first of all, with respect to reserves, China has massive reserves, at least relative to the United States. Before this broke out, if memory serves, I'll see if I can find this. I probably have this. I believe it was 1.3 billion barrels. Use strategic. I've never actually looked it up on here, but I'm assuming Bloomberg Terminal has this. Does it? Do they have the Strategic Petroleum Reserve for China? Let's search for that. Let's see. That's the U.S. one. I'll keep looking. Oh, here we are. What's this? This is just on Wikipedia. So, according to Wikipedia, 1.3 billion barrels was what they had. But I think, to Monday Morning Quarterback's point, what we saw in Singapore jet kerosene prices was indicative of the problem, right? It definitely suggests that that is certainly an issue. And there was something else here. So Anil P 6699 said, "What are the chances of passing $200 billion war bill the Trump administration is asking for?" You have any thoughts on that?
See, I'm not really much of a political pundit, and um, The Republicans might, there's just the way Washington goes, as if the Democrats will just say no to everything Trump wants. So there will be just as much of a fight over that as everything else, and like these super long lines we're seeing at airports,
Hmm.
that because people can't get paid. So
I also think, this is an interesting situation because there are Republicans who are not in favor
yeah,
of the military conflict.
yeah. So
I mentioned Rand Paul before, and there are undoubtedly others. And the longer this goes on and the higher gas prices are,
mhm.
the more people are going to come out in opposition to it, even if they were initially supporting it. Even people who might support it philosophically now would not support it openly, I suspect, if they believe that their own constituents are very much opposed to it or feeling
Yeah.
the pain from it. And that is so I don't actually know. I don't know that we'll ever know, but I don't actually know exactly what intelligence the folks in Washington were privy to at the time that they made the decision to strike. It is because of this, it is hard to trade the difference between whether or not those strikes were necessary or not. That might be not just unknown now, it might be unknowable.
Yeah.
Versus the very real pain that people are experiencing. In other words, you're asking folks to handicap what they think the chances were that something bad might have happened,
Mhm.
when they're looking at a country that is in one way or another been at asymmetric war with the United States for 47 years, but for which they hadn't necessarily seen direct or felt direct pain as a result of that.
Mhm.
But gas prices are something very real that a lot of people experience each and every day. So my guess is that that Congress is, that there's a lot of people who are struggling mightily with that, even if they think that the strikes were justified.
Yeah, well, I don't
Um,
see the Republicans having the votes to do it all by themselves. Having enough, because there are enough Republicans that are anti-war, that um, they would need very, very good reason to go ahead with this, and so some are vocal about not doing it. So I don't think they got enough votes there. They'd need to get help from Democrats. I don't think Democrats will give Trump any help to do anything. So they'll probably, at least for the near term, not get their money. Um,
I wonder, the next question would be, if they don't get funding, um, does that mean that we effectively withdraw? We say we've degraded their military enough. We're going to move the fleets further from the region,
mhm.
and we're just going to stop the campaign, and that's it.
Yeah, that's
Do you think that's a
that's
possibility?
a possibility. That in the uh, grand scheme of things, that probably allows Trump to leave and save face. I don't know. I'm not an expert in all this body language that goes on between the various players in Washington, because I find so much of it is irrational.
Um, I mean, it's perverse. I'm not sure it's irrational. I think it's perverse in many cases, but I'm not sure. I mean, if you understand what their motivations are, I guess we can sometimes make some sense of it.
Hmm.
But it seems to me that um, he could at least place some blame by
Yeah,
saying
it's not.
we degraded their capabilities, but we needed another 200 billion to solve the
Finish the
problem
job.
once and for all, and finish the job, and we didn't get it, so we can't do it
Yeah.
as much as we'd like to. I would imagine that Democrats in Congress would probably recognize that gives them an out. They don't want them to have an out either,
Yeah.
right? So it's kind of hard to say, but throwing a lot more money at it, if it's becoming increasingly unpopular, would seem to be also increasingly,
Yeah.
therefore, unlikely. So Finwest says Hawaii is in the same housing situation, local population getting squeezed out of their own neighborhood due to accelerating costs but not personal incomes. Yeah, housing costs have grown substantially faster in the United States since the 1970s than incomes have. So the things that have gone up much, much faster than income since the 1970s include housing, medical care, education, higher education. So, and the things that have come down, those are, and what's interesting about that is that these are all areas where, we can say it's a coincidence or not, but these are all areas where the government plays a big role and does try in some ways to, subsidize a portion of it and meddle quite a bit. The government does meddle in housing, whether it is by, regulatory issues with respect to construction and things like that. It does subsidize and sponsor some as well. Obviously, the government has a lot to do with healthcare, and of course, they have a lot to do with education, higher education, especially in terms of lending. Not everything has gone up in price. The cost of a new TV, for example, as a function of median income, has actually dropped considerably since the mid-1970s. And not only has it dropped considerably since the 1970s, the TV that you get today is nothing like the one you got then. So, but of course, the government doesn't have a whole lot to do with that, with building TVs. The Chinese do. So I think one of the reasons that also possibly that you can have this huge move in the personal finances of individuals in the country and have it not necessarily causing huge angst, not only because it's taken a long time for things to move as far as they have, as I was using my prior analogy of the continents drifting apart, but if we think about bread and circuses, right? Entertainment is something that people have much easier and readier access to, thanks to these little gizmos right here. So the circuses are at our fingertips, and maybe that has also helped mitigate some of this. Let's see what we have here. So Steve Garcia says, withdrawing funding by Congress can also be perceived as not supporting U.S. troops. Optically bad. That's an excellent point. Regardless, and actually, the interesting thing is that for a member of Congress who, let's assume you have a member of Congress, and I'll pick one, who's a Democrat, not in the House, but in the Senate, John Fetterman of Pennsylvania. I haven't seen his most recent comments or posts on this, but the last I did see suggested that he was in favor of the military action going on right now. And it would seem that for somebody like that, don't necessarily have to say I support the president, but I do support the troops and I do support U.S. action to intervene against the leading state sponsor of terrorism. So it is possible that you could get some people crossing the aisle to pass it. I think it feels less likely in the House than in the Senate to me. But you could have people crossing the aisle for those reasons. To say, I'm not in support of the president. I'm not in support maybe even of the decision to strike at that time. I think it might have been wiser to do it at a different time, or maybe not at all. But having done it, you know what they say, you trade from settlement. You trade the position you're in, not the one you wish you were in. So that's a possibility. Monday Morning Quarterback also saying big gasoline importers don't really refine their own. Indonesia, Australia, and Vietnam. Yeah, I mean it is interesting. So the products do. That is an area where the United States also has some strength. We have a lot of refining capabilities here. We have probably the leading refining capabilities in terms of hard to refine oil in particular, heavy and sour grades. Sour grades being the ones that have much higher sulfur content and so on. So we do have relative strength. And you were talking about Valero. This is a name that you traded quite a lot, and I have a chart of that one. And that thing had already been a rocket ship even before all of this. So let's just go right up until it was already up 95.5% off of the April 2025 lows,
Hmm.
even before these first strikes took place. And since that time, uh, it's up a decent bit since. Let's see, it's up another almost 20% since
Yeah.
then. What's your thinking on Valero
Well,
here?
I could see if you would take a look at their income statement. I think they're making $9 a share, something like that.
Let's take a
Um,
peek. So this is full year adjusted EPS estimates,
16.
which
So yeah, that's
for
what I was
this
thinking.
year, $16. Yeah, that's for this year. Last year it was about 10 and a
Hmm.
half. That's a pretty big
Yeah,
increase, and this is, oops,
and I think that's
okay.
that can last a while. Um, that these higher crack spreads we remain in place, and I think it's a another area that makes some sense to own if you don't like trading commodities. There's a lot of people that are uncomfortable with commodities. Some people don't like futures. A lot of the commodity ETFs are not particularly well designed, um,
Mm-hmm.
and so it provides a safe avenue for people that prefer stocks than to trade the commodity. Um,
How do you feel about being long or short volatility here? So this is not a level at which the VIX index typically lingers for a long
mhm.
period of time. So here we are at around 27. So let's just do a little bit of translation for everybody. If implied volatility is 27%, then what is that saying? It's saying that, and where's my calculator so I can make sure I'm doing my math correctly. I always have that thing lying around. What the heck did I do with it? All right. Well, we can use Excel. Old habits die hard, but I like my old HP 12C.
Mhm.
Just, I just, uh, okay. So let's take a look here. So, um, to calculate the standard deviation for a day, or the mean absolute deviation, which is sometimes referred to as the expected or average move, first you have to take the annualized number and translate it to a day or to a month. So what we're going to do first is we're just going to divide that by the square root of time, which is 16. Oops, 16. So take this, that, divided by 16. So that's 1.7%. It would be the standard deviation for a single trading day. And if you multiply that by the square root of 2 over pi, which as it happens is about 0.8, that gets us to 1.35%. Okay, so what am I giving you these numbers for? This is how much you would expect the S&P to move on average if volatility was relatively constant at 27%
Yeah,
annualized from one day to the next. That's a pretty big move, right? Because what that's saying is if the S&P is, call it 6,600 or 6,500, just put 6,500 in there, that means that you're expecting on average an 88-point move in the S&P per day for a
yeah,
month.
that's pretty wild.
So that's not what we're experiencing right now. We've had a couple big moves. We had a 100-point move on the pre-open yesterday, and we've had a couple moves of this magnitude, but this is significantly higher than what we're currently experiencing. So what that tells us is that the options market is baking in a potential violent move or two over the course of the next 30 days. And so I guess my question to you would be, would you prefer to be long or short vol, long or short options, given these statistics here and now? And if you were to take a position one way or the other, what offsetting position would you contemplate as a mechanism to potentially hedge the risk associated with the whatever side of the trade you took?
Yeah.
What are your thoughts? What do you think?
I I think that's a fair analysis. I'm kind of surprised that equity markets haven't reacted a little bit more negatively than they have, but we've kind of had a steady march down. If you look at the S&P 500,
Hmm.
let's say year to date, we're up there about almost 69, 80. Now we're at 65. So it's sort of like chopped its way down since it peaked. Uh,
Well, you know what they say, nothing good happens below the long-term moving
yeah,
average, and we're below it
yeah,
now.
we've.
And what's worse, if anything, is that it tested it yesterday.
Hmm. Oh, and then bounced
Um,
back.
yeah, so
Uh,
yeah, I'll shorten this up a
that's
little bit so
often
we can
not
get
a
a
good
closer look.
sign.
So you can see violated it over here, and then it bumped up against it
Hmm.
intraday yesterday. So we went up against it, closed below,
Hmm.
up against it, closed below, and now we're not quite back there.
Yeah.
Um, that doesn't feel good to me technically. Let me offer my answer to the earlier question that I was providing to you, which is that I think this is a good environment for selling off some upside.
Yeah.
I think options premiums are higher than the day-to-day price action suggests. Um, and consequently, I think that if you are in stocks selling some upside calls or selling some upside call spreads might actually be a better play. The rationale for that is that I think that premium is too high, but I'm also going to suggest that if we go higher, it's not going to be a drift higher. It's going to be a snap
Yeah.
higher, and it's going to happen because um, some cloud has been
Yeah.
lifted,
A
and
deal has been
if
struck.
a deal has been struck precisely. So as a hedge against that, so if you are long stocks in general, and if you are short premium in general, whether you just decide to short vol or you're selling some upside call spreads against your common, my suggestion might be that you contemplate uh, a hedge on crude to, believe it or not, I hate to say it, but an even higher level. That is to say that if things are going to roll over from here in a sharp way, that is likely because the situation got worse in the Middle East than it is right now. And what would worse mean in that context? If worse in that context means you don't like being short volatility, that means something sudden has happened. Sudden has happened would be the U.S. attacks Karg Island,
Yeah.
or Iran attacks some additional significant, important um, oil and gas facilities, and you have a sort of coincident factors, and those two coincident factors would be we aren't going to see things straighten out in the Strait of Hormuz. Um, a lot of double entendres and accidental puns in these conversations, it would seem, um, is not going to be resolved quickly, but also that you could have another leg, like sharp leg higher in oil prices. I think it was Goldman Sachs that came out and said that they thought 120, 130 was not
Yeah.
unrealistic. So let's just take a look at what that kind of a spread would be. Oh, let's look at the skew first. So I'm going to do that first because owning some put spreads or maybe ratio put spreads, we were talking about that yesterday on open mic. That's another possibility. You could own some ratio put spreads because the downside skews are pretty
Yeah.
steep. But here you have a situation, you're looking at these skews right now, you can see that the 50 delta, I'm so used to, I have to figure out what's going on with my annotation tool because I've gotten to the point where, here, I'll just use Brent's surface. What I was going to point out with my annotation tool, if it was working, which it is not. Oh, that is interesting. Look at this. Look at that. This is, okay, you know what? Check this out. So the shape of the volatility surface in Brent and West Texas are not symmetric. There's a put skew in here on,
That seems
look
a
at
little
that.
crazy to me, but
Huh. That's, so the downside puts in Brent are trading much higher than those in WTI.
yeah, well, maybe there's somebody who thinks that the widening of the spread between Brent and um, West Texas has gotten too big. So
Hmm.
any correction is going to
Is going to cause this to
a
fall
lot
more.
more. Yeah,
Okay, so that's an interesting
because
thing. So
people view
what I
Europe
will,
as being more vulnerable to the Middle East than the U.S.
mm-hmm.
So as you were mentioning earlier, I forget if it was on the show or before the show. We were talking about how you thought Brent maybe should have been even higher um, relative to West Texas.
Yeah, so that's I do agree that there's a couple things that people, there you see the dynamics of this playing out in spreads in a couple places. Here's an example. I'm going to just clear this, and hopefully I won't accidentally just bring up my annotation tool the wrong way. Air France, which I think is Air, here we are. Let's take a look at this. This I thought was kind of interesting. So if you take a look at European carriers relative to U.S., and I'm going to add Delta to here because Delta is the best balance sheet in the U.S. carriers. Look at this. Look at this relative performance since late August. I'm going to actually put this in. It's going to be August 25th of last year. I think this is quite interesting. So pretty big divergence right there between the performance of Delta, that's the blue line, which is much higher, and Air France KLM, the Dutch carrier, French-Dutch, which is substantially lower. Yeah. I think that's quite intriguing. So my thinking is that I would be net short premium. I would probably sell upside call spreads. I would maybe trade downside ratio put spreads, so that if you have a drift lower, but just to take advantage of the high put skew, and then potentially have the possibility of having some underlying stocks put to you at lower levels. Yeah. Let's pull this up. I'm going to actually give a more concrete example.
So what are you thinking about? 1.5 to 1 or something?
Yeah, I think something like that with the eye towards legging into it. Something I kind of went over on open mic yesterday, but I was saying, look, put on a put spread and then leg into more of the short put side if and as the market rolls lower, as one possibility. So, but on the crude side, I'm going to use USO because I actually can't pull up futures on Options Play, but this is a nice and handy tool to sort of illustrate a trade. So let's just use USO in this case and say that as a hedge here, one of the things one could do would be to trade call spreads because of that skew, right? So if you trade an upside call spread here, and where are we now? 114, and this is really more of a disaster protection type of thing. So let's look at the sale. 120. What's a 120, 130 run you? So this is pretty interesting. I'm going to bump this up a little bit more. Let's go to 135. Let's see what we got. So here you have a pretty good example. You could never get a long call spread in equities typically for these kinds of numbers. You're paying a quarter of the distance between the strikes. And I'm looking at this as a hedge. So in other words, you sell some premium on index, which looks like it's a little overpriced to me. One of the principal causes of the market rolling over more severely from here would be that the situation in the Middle East gets worse. As an offset, you could get a call spread on USO that pays 3-1, right?
Yeah.
And think about this as insurance. So it's neither our hope nor our expectation that crude prices get up to those levels.
Mm-hmm.
But if you're going to be short premium on your equity book, that would be sort of one of those things to think about. The other thing that I had pointed out was that huge SPX 5300, 5200 put spread that traded last week. Somebody bought 45,000 of those spreads, expiration May 1st, for $1.28 a contract. Outlay of about $5.75 million on a trade that would be worth $450 million. Thank you, Max Convexity, if you're watching this, by the way, for pointing it out, because I skipped a zero when I mentioned this before. 77-1 payoff as a complete disaster protection trade. You can't get it for that now because obviously things have softened up. But I do want to point out to folks that you can still pick up that trade for about a 50-1 payout. When I was looking at that earlier today, so less than $2 for a $100 wide put spread in the event that we go into a formal bear market, which is about what that 5,300, 5,200 level would represent, peak to trough. What do you think of that? So short premium, little bit of a tail risk hedge on the S&P that pays 50-1, and a little bit of a, so essentially, you know what that trade is? I'm synthetically constructing an iron condor, I guess. Right? Because I got a little bit of a crude protection to the upside, a little bit of a tail risk 50-1 payoff hedge on the S&P, and then short premium. What do you like? Do you think that trade's a good idea or a bad one?
I don't know. I hate complicated trades. I'm a simpleton.
I have a bad habit of overcomplicating things, but I'm really just trying to figure out how to get short premium and not get my face ripped off.
I would if you wanted to get a short premium, in the near term I don't see the price of USO going higher, so I'm happy of selling some kind of out of the money call spread for doing that. I actually kind of like a iron condor in oil, just straight up, because I don't see I see a floor under the price too. I mean, I don't see the price getting down below, let's say 95 in the near term, or above I don't know, 140 in the upside. Now, what could blow that up? Well, one of these guys throws a nuke at the other, because Iran and Israel have been saying, well, if you keep this stuff up, we're going to drop a bomb on your nuclear power plant, and then if that causes, and of course, if they did that, that has the potential of throwing nuclear waste all over the place. Then then there's a little tit for tat going on. They have more facilities.
What do you think of something like this? Yeah. What do you think of something like this? So here's a short-dated iron condor. Notice that this is one that cannot lose because it's a sort of a broken wing jobby. Yeah. Cannot lose no matter how high it goes.
Yeah, I like that.
So essentially, your short premium in here. Michael Anthony is saying Trump spoke on CNBC. Is he talking on CNBC right now?
I kind of like this because I don't really see the price of USO. I think the probability of it going under 100 is pretty low. And let's say a 1 month time period. I don't know what kind of, you and going out here in May. So April, you got about 45 days, 50 days.
Yeah. So Tucker D Dog says Saudi Arabia reportedly pushing Trump to continue or even escalate. I did see that. I saw yesterday that MBS had hinted that he was going to join the U.S. effort. Wow. I don't know if that was...
that would be incredible. I mean, wild. I'm not sure what the adjective should be here. The Middle East is...
Does it start with an F?
Is just, it's like who is aligning with who, and alignments are changing, and since I'm certainly not an expert on the Middle East, I've only been there myself a few times, but only for short trips. I haven't had it.
That makes you a lot more experienced than most. You have financed projects
Yeah,
not dissimilar to the ones that are being affected by this current conflagration. You have lived
yeah,
overseas. You've lived in Indonesia. You have worked
yeah.
tangentially in the oil business and other engineering and uh, construction types of projects in the past, done project finance, and you've been to these places.
Yeah.
So I'd say that makes you a relative
Yeah.
expert, actually.
So, I financed, or ANZ, when I was there, we financed Ras Laffan, which is, I recall, an LNG facility. We did a number of, I can't, to, Twili, I forget what they called them, a bunch of power desalinization plants. Now that's the
Hmm.
real wild card. You don't have to go after nuke plants. You don't have to do any of that. You just have to go after the desalinization plant because most potable water in the Middle East is coming from um, desalinization plants.
Yeah.
And so
Hmm.
you can really create massive turmoil there if you take out the desal plants.
Yeah. I'm reminded of a scene, I think, from Lawrence of Arabia where a guy gets shot at a distance because he's taking water out of a well that does not belong to him. Um, Probably most of the people. Well, actually, I don't know. People who watch our podcast probably have more experience with movies like that one. Um, but yeah, I mean, it is an important point that the number of people that live in the Middle East could not without the desalinization plants. Not even close. There is not enough water there to support the populations without them,
Uh, yeah,
by a long
yeah,
shot.
and they don't like to take water out of the ground
Mm-hmm.
for reasons I won't discuss on in public.
Ah,
So I'll
okay.
tell you after the show.
Oh boy.
Uh,
So, I guess you and I both are inclined to try to find a way to sell some premium here. You are inclined to do it on the thesis on crude because your logic is that we cannot revert back to the pre-crisis
yeah,
pricing.
I don't see that. No,
Um,
higher for
and
longer.
part of higher for longer. And your logic on this is basically that it takes time actually to essentially fill the gap in the supply chain.
Hmm.
Is that
Yeah,
sort of it in a nutshell?
yeah, and
Okay.
some of the supply chain has been blown up, right? And
Qatar's big gas
yeah,
facility got
so
hit.
there's been some
Um,
disruption already. So they don't even have the capacity they once did to turn everything back on again.
yeah, I mean, I will say the good news is because this is and maybe you can speak to this a little bit before we end today's conversation, which is that in the United States, it is a bigger issue for us to curtail oil and gas production in the states, by virtue of how much of it comes from fracking.
Hmm.
So one of the things that probably is not as well understood by people who haven't really trafficked inside the oil business as much as you and I have is that a conventional well, you can curtail production, you can slow it down, but if you shut off a fracking well, you cannot just turn it back on. It's not like there's a conventional head and there's pressure underneath, or even just pumps and pump jacks, and you can start them and stop them. If you shut down a fracked well, you might actually permanently impair the
Yep.
well. So they rely on not only you going down and cracking the ground underneath and injecting sand and water to open up the fissures in the
Yeah.
rock, but if the oil and gas stop flowing through it, you can end up with some real problems. That's the only good news that I see, is that the Middle East are conventional wells, by and large, so that this is not as much of an issue. You can ramp, but even so, it does not ramp like a light switch. Um, and the supply chain in the oil business contains a huge amount of the essentially the stocks of oil and gas and product reserves that we have at any moment. A lot of it exists in tanks, in ships, in pipelines. And when you start impairing the natural production and flow through those, through that process, through the midstream process, it does not quickly get
Yeah.
done. Monday morning quarterback just said DJT is done talking. And then Tucker D Dog said DJT can't help himself. He is never done talking.
That's a good one.
And then Michael Anthony said CNBC cut to the White House where Trump made a speech, but he is off now. So I may go back and just rewind that and hear what he had to say. I think the important thing that everybody can do is actually go take a look at the futures. If you want to know what the impact of what he had to say is, I think map what the futures were doing and replay what he was saying at the same time, and you can see what the market cares about by seeing what caused it to rise and fall. So with that, they're a very casual conversation today in some ways and a very serious one in others. But as always, I enjoy my conversations with you, and I hope those who listened in found some of the things we had to say helpful in one way or another. So until next week, everybody, thanks for watching. Check out the Options Edge, where Mark's been publishing a lot of articles about what's going on and how it impacts, and how it impacts some stocks. So if you don't do that already, and if you're not a student of his at Rutgers, and you're not thinking about going back and getting an executive MBA or something, check out his articles on the Options Edge. All right, everybody. Thanks so much for watching.